Great stuff. Hi, everybody. Thanks so much for joining us. Welcome to the inaugural live stream recording of the M&A Zing podcast. This is a series devoted to acquisition entrepreneurs, search funds, holdco builders in the UK and the EU. Each week, we dive into topics and challenges that impact SMB succession M&A and explore the highs and the lows of searching, acquiring, owning and operating small and medium-sized businesses. For those of you who don't know me, I'm Gareth Hawkins, CEO of BizCrunch, which I co-founded after a career to date of buying, building, selling and investing in private companies. And with me this week is Adam Kempner. Adam's Managing Director at Coefficient and one of the founding team at BizCrunch. So hello, Adam. Welcome from the UAE. What time is it there?
It is. Do you know what? It is 7:30. I have to still do the math because I've kept my clocks on UK time. So yeah.
Oh, right. Only temporary visit then. Not emotionally committed to the idea yet. Glad to hear it. It'd be a shame to lose you. So we've got a pretty packed agenda today. We normally run these for about an hour, about half an hour, a live recording, and then a half an hour kind of AMA for anybody that's present that we don't record, Chatham House rules. So yeah, do put your hands up, folks, if you've got anything that you'd like to chime in with towards the end of the show. We're going to go over some news, some happenings in the search fund space. It's a pretty exciting time for search funds and holdco building in this economy. And then we'll get into financing as a key topic and challenge for the space. I think everybody laments and wishes it was more accessible. So yeah, let's dive straight in. What's happened in the world of search funds in recent weeks? I guess we could probably, given where we are sitting at the beginning of February, we probably can't avoid acknowledging the big win for CorpAcq and their sort of majority acquisition by TDR Capital. That great validation for all of us, right?
I think it shows, doesn't it, that one, there's continued growth in this space. More and more, I think, is filtering out from the US into European and UK markets. And it's more validation that you can build up a sizable group and get really solid, tangible exits, which is great.
Yeah, it's incredible. I mean, it's a journey that's taken him, almost 20 years. I think 2006, CorpAcq began. And here they are, 40 portcos, 730 odd million in combined revenues. Nice, healthy EBITDA at 17%. So yeah, unicorn valuation, looks like it. Valued over $1 billion, which may be a bit of an anticlimax for him because obviously they were planning a SPAC at 1.5 billion US. But you know, I guess Michael Klein's loss is TDR's gain, and you know, getting a, I guess 10+X multiple is still not to be sniffed at for him. So yeah, what do you think as a result?
I think they've done pretty well to also, as you said, drive the growth and keep the margins high through that period. It's not going to be that easy for us, everyone doing that journey, right? But it does provide, as you said, validation and proof, and demonstrates that you can get substantial, as you said, like unicorn type valuations, even in that space, just from starting out with acquiring smaller companies and building it into a portfolio. So yeah, I love seeing that recently. It's great.
Yeah, it can't have been an easy journey, and it's quite a broad portfolio of businesses. In fact, I noticed that one of their portcos is, they've got a lot of plant hire businesses, and one of their portcos is Adlington Welding, which reminds me of my days back in industry. So Nigel did well there to sell to Simon. But yeah, it's indicative of the kind of stable, steady, growing businesses with, you know, professionally managed that he seems to have acquired, which I think is a very sensible sort of premise on which to build a group. But yeah, it can't have been all sunlit uplands over a 20-year process. But you look at the portfolio and yeah, you know, plant hire companies, forklift companies, and then some retail cotton traders, which may have been opportunistic given their troubles, I suppose. So yeah, I think if anything, it's a good avatar for, you know, a good inspiration for holdco builders anywhere, that actually you can play the valuation multiple arbitrage game. You can buy at, you know, modest multiples, build a substantially material group, and then sell it at a sizable multiple to mid-market and above private equity. So well done to Simon, and now he gets to devote all of his time to rugby.
Exactly. To be jealous of that.
But hopefully not all of his time.
I thought was interesting is it's like the diversification, as we said, of, because typical buy and builds, right? Very typically sector specific within niches, lots of integrations and synergies in that kind of model. And I think there's some skepticism around the holdco model. How diversified can you go? And it's evidence again, not to say that you can just pull in everything from all sorts, because there's a level of synergy and crossover there. But yeah, you can build a group coming from slightly different sectors in that model too, which is interesting.
Yeah, prove the naysayers wrong. That you don't have to be wholly concentrated in one particular vertical or segment. You can be diversified, and it actually can be to your benefit. It doesn't preclude you from, taking a combined valuation and exiting the group in full. So yeah, really great. And let's hope that this is the start of seeing a few more like this. But I think it does speak to the kind of necessary conveyor belt that we need to see in the economy. We need more. The Nordic economy has loads of this, and actually, I'll bore anybody senseless telling them about how, my exit was to a Nordic permanent capital company, listed on the Nasdaq Nordics, now trading at 40 times price to earnings. But great culture, long-term stewards of capital and legacy, really makes all the difference. But we don't have enough of that here in the UK. We don't have equivalents really to any great extent. There's one or two, but blimey, do we need more? So let's hope that this is inspiration to other entrepreneurs to go out and acquire a multitude of small businesses and become a factory, if you like, of value creation that private equity can then pick up when it reaches a material size.
Yeah, and I think drive collaboration between others as well, because for those that are not everyone can scale that quickly, that fast, and do so many acquisitions, but maybe by partnering with others in similar spaces, again, there's times to collaborate where you can actually build it into a more collective entity. So I think that's the way we're going to scale it over here faster, right? Given we're, as I said, still relatively immature in the market, like you referred to.
Yeah. I think it should be a good catalyst or stimulant for more activity like this. So moving to the other end of the spectrum, obviously Simon's had his majority exit, and now you've got folks at the beginning of the journey. This week we've seen two new search funds in the UK that have closed their fundraisers and are now off searching and looking to acquire, which is fantastic news. I think that again speaks to a bit of a return of confidence and liquidity in capital allocation. We'll get on to in a minute why maybe there's still more work to do there to increase the accessibility to capital. But very many congrats to Novi Growth Partners, Josh Neely and Ben Saward. Josh is actually ex-SME Capital, so he knows the space quite well. So yeah, Novi Growth Partners, loving the thesis behind what they're doing, and great to see them now out there, tooled up, ready to go and find some great acquisitions. And then hot on their heels, Lakeview Partners, Alex Shin and Nicolo Fantirizzi, Nicolo being ex-Citi and ex-GE Capital, and Alex Shin being from another part of the world that I spent some time in, the Web3 community. So seeing Alex and Nicolo doing what they're doing with Lakeview Partners, again having successfully raised this week, is tremendous. So I don't know about you, Adam, but you connect with a lot of searchers over LinkedIn and the various community search funder, etc. You're seeing an increase, right? There's more of them activating than before.
Yeah, I found it really interesting actually. So I think more and more, like as time's gone on, it's filtering over, as we said, into the UK market. There's more appetite to kind of get into that asset class. I think it's a combination of knowledge, awareness, accessibility, and both from a funding perspective and from a search perspective, as there's more credible searchers, demonstrate a great thesis of what they're looking to acquire with the right background, it's bringing in more search funds. So yeah, I've definitely experienced a massive uptick in that in recent times. It's kind of on that upward curve on the trajectory. And I think even there's some appetite from people I've spoken to of typical search funds that look overseas in the US to get into UK and European markets, which is interesting. I think over time we'll see more and more of that once.
Yeah.
I'm
really glad that you raised that point, actually, because there are increasing numbers of US private equity and capital allocators that are seeing the sort of comparatively compressed multiples of the UK market as being a real opportunity. Could you speak to that a little?
Yeah, I think so, for sure. So I think that it feels like, given where we are in the UK market versus the US, there's a lot more opportunity on the multiple arbitrage. I think what the US has had in recent times that we haven't necessarily had in the UK is the SBA loan side of things, which has naturally provided more leverage, reduced risk, and given more access to financing. We've seen British Business Bank do like the growth guarantee scheme, and there's more initiatives coming alongside that. And I think as that hopefully continues to evolve and provides more security to lenders, even more so, we're going to see more appetite to move over. But where the UK is positioned at the moment, I think where the advantage of searchers is there's still a lot of accessibility to more deal flow, which can therefore drive lower multiples, given there's more challenges, right? Supply and demand piece. So that's really exciting.
Yeah, that the fact that it is a less mature sector here, or asset class here, the search fund space, it's not as over competed for deals as it is in the States. I definitely think keeps multiples sensible. We have an abundance of companies here that need to pass on the baton. I think the main, competitors are where you kind of nudge up against the sort of 4 million EBITDA. Your lower mid-market private equity comes in with the sort of multiples that they can put on the table. But if you're a little way away from that at the sort of micro cap, I do think the multiples are very attractive if you're looking to allocate capital into this market. You mentioned about the British Business Bank there, and obviously it's not a direct comparator to the SBA, and goodness, we hope that the SBA continues to be given the mandate that it has. I don't know if you watched Mr. Musk last night in the Oval Office. Yeah. Oh, that was a trip to the Twilight Zone, wasn't it?
With his son putting his fingers in his ears whilst he was trying to talk serious, which was brilliant.
Oh no, I thought the pretend to shoot all the journalists was quite telling of the conversations around the dinner table. But
yeah, the irony.
It was the Twilight Zone. Anyway, I do hope, despite Elon's comments about the SBA on X, I do hope that the mandate continues. And if you read the paper, the sort of manifesto, if you will, that was pushed out before the election, the SBA does have in the master plan that the SBA does seem to have a role, but involves less direct lending, but more autonomy to make decisions around catalyzing small business in the the US economy, which long may that continue. So I really hope it's not in the gun sights for Doge. But turning to this side of the pond and looking at the BBB, the growth guarantee scheme is great. The maximum deal quantum is too small. The lack of promotion of it as an M&A lubricant or an M&A product is probably to its detriment, and the continued need for personal guarantees to a considerable extent by the lenders, rather than just for the gap that isn't necessarily government underwritten. I do think these are all barriers, but I mean, also one barrier is the way that the total budget is allocated. So on a quarterly basis, and we've seen this firsthand with some of the very active GGS lenders, quickly using up their quota, but having unused quota from some of the sort of more traditional high street banks that are in the scheme, that they've kind of clawed quite a bit of it and said, oh yeah, we can use that, and then not. It's sort of holding back deployment of capital in the maybe more of the challenger banks. So that needs to be gotten to grips with, I think. And as I say, you've seen that firsthand, I imagine.
Yeah, no, exactly that. It's a good stepping stone into where we want to get to. But in terms of where things are at now, it's still, in all the challenges you alluded to, still relatively inefficient. And as you said, it's not clear that it's actually directly supporting acquisitions. It's very much positioned around existing businesses and driving growth. And actually, I think there's still a lack of awareness, even with that it can be utilised towards funding for acquisitions, which I know we'll come on to. So, yeah,
well, let's
still
get
a bunch
into
of
it,
work
shall
to
we?
do, but it's useful for now.
Yeah, absolutely fine. Let's get into it. I think that's probably an ideal segue opportunity to go and talk about the sort of state of financing for microcap M&A in the UK. So, there's two sides to the equation, right? You've got your debt financing and you've got your equity financing. And traditionally in search, obviously, equity financing can be quite appealing and lucrative to the capital allocators, the investors. But leverage is what drives the IRR ultimately and the return on equity. If you can get more of your deal structure leveraged, then that's perhaps more efficient for driving gains. So let's talk through the kind of products that are available, if you like, to M&A in the UK from the debt financiers. What have we got to play with, and maybe which ones provide more certainty and which ones provide less personal security. Let's talk about that balance.
Yeah, no, agreed. So yeah, I think there are various types of debt funding and lending, and as you alluded to, I think for search entrepreneurs in particular, leveraging is key, right? Because that's naturally where most of the upside can come from, especially on some of the typical investor equity terms with step ups, which again I'm sure we'll come on to. It's like if you raise it all through funding, then you'd be over diluted significantly. So yeah, in terms of lending, I think there's a bunch of different things. It depends on the type of business and the securities available to that business. I think you've got cash flow lending, which, as it kind of alludes to in the title, is based on the free cash flows in a business. I think for that type of lending, when it's not secured against another specific asset, it needs to be a highly profitable business that is providing confidence of there being recurring, predictable cash flows. That's kind of key. So certain businesses, I think contractual businesses and stuff like that, is going to be recurring revenue businesses where that's lending to. And then you've got a whole bunch of stuff under asset-based lending where that can cover property, that can cover inventory, stock, invoices, and typically the lenders are securing their funding against those assets, and dependent on that asset value, a percentage of that can be lent against. And that percentage, again, can vary based on what that asset is and how secure that asset is.
Ideal ABL for capital equipment rich companies, lots of fixed assets on the balance sheet, right? And I know there's a sort of tendency or a propensity towards asset light businesses in a lot of the kind of SMB M&A suitors. But I see an increasing number of transactions like logistics companies, coach and bus companies, CNC, precision fabrication, precision engineering companies, where they've got a lot of capital equipment. It's rolled off its lease, but it's still got asset value that you can refinance. I know of a deal that completed sort of back end of last year for about 12 million kind of net asset value that had a lot of fleet that was refinanced in order to come up with quite a sizable percentage of the consideration for the seller. So there's some really great examples of where ABL is super useful.
And in your experience, what percentage of those assets could be lent against? I know it does obviously vary somewhat on what that asset is, but if you look at core machinery, property, vehicles, what do you think is typical in your experience?
Well, obviously they all got to be free of other leverage. They've got to be, wholly owned. So the peppercorn or whatever it was that was paid to transfer the ownership of the asset at the end of the lease or hire purchase. So they've got to be on balance sheet, stood in at X, and probably reasonably valued on the balance sheet, because you can't really write them up just for the sake of borrowing. But you might end up with a residual value post lease of depreciated value to sort of 30% of their original principal. So if you've enough of that, and they, it's a sizable set of assets, then it could release enough capital to pay, half the consideration maybe, which would exist alongside profits, separate to the cash in the business. There's lots of ways in which this could become part of the bigger picture. But I've seen some nice wins for buyer and seller where there's an element of deferred, sort of 30-40% of deferred, and it's been working to the seller's advantage that the buyer has understood how to navigate ABL and help them to release this value from their balance sheet. So the alchemy is probably sometimes the big win here, because many entrepreneurs don't necessarily know how to go about refinancing to that extent within the sort of rules of the Companies Act. So I think maybe look at a 30% potential residual value, and what could that then contribute to the overall consideration? Maybe up to sort of 30-40% of the consideration. Could be quite nice.
Yeah, I think that's fair. One thing you alluded to, which I think is actually important to highlight, is the need to be relatively transparent through acquisitions, because you need the engagement of sellers through that process, especially for those tangible assets. So I think some people think that the best way to do it is to not be as transparent around the sources of funding, and leave things as late as possible and line things up. But actually, you typically will need surveys, assessment, engagement, and support of the seller to raise the debt against those existing fixed assets. So that's really
you've got to be really, they've got to be engaged in the process. You've got to be really upfront that, look, this is how we're financing the deal. We're with you on this journey, but you need to play a part in this because it's still your company while we're doing all of this pre-loan due diligence. And you can't do that stealthily. It's got to be very much an open book for all parties. So it's just an adult conversation, right? It's a grown-up conversation. So I don't think we live in a world where if you're bringing a lot of leverage to a transaction, you can obscure that or hide it from the seller, right? It's important to get that out there.
Yeah.
So so that's ABL, and we've talked about cash flow. What about good old-fashioned term loans? Are they still a thing?
Yeah, term loans, I think, are definitely still a thing, and I think it's an alternative, right? If there aren't fixed assets that can be leveraged within a business, which is typical a lot in the search space, people looking for service-based SMEs that maybe don't have a huge fixed asset value. And that can be lent against using invoices or contracts as more of a security. So I think how lenders will view it typically is they'll look at all the assets of the business, put it in kind of one big pot, if you like. So if there aren't many fixed assets, the other assets that exist will be typically outstanding invoices, right, or upcoming invoices and contracts. And they'll be able to lend against that dependent on the risk profile and the strength of them. And I think that depends on things like who are the customers in that case, how strong are they, what's their credit history, and what's the relationship the business has with those customers. Do they always pay on time? And I think lenders will build up a risk profile of saying, okay, these are all really great customers, they've got really strong credit history, you've had a relationship with them for a number of years and you've paid on time, then a high percentage of those invoices will be considered we could lend or give the amount of funding to that level. And,
okay, so we're talking about, so are you talking about trade finance and invoice financing?
So I think I'm kind of probably combining a bunch of them. So I think even with term loans can be structured against those assets, but just over an extended period of time. So you can look at the value and be like, cool, we can see there's £1 million of invoices coming through each month, for example, that are and most of them are really strong. And based on the payment terms, we think there's X amount of funding available there. And then that can be spread over a term loan. I think that's one way of looking at it. And then the other way is like, I think what you're going to refer to around invoice financing specifically, which you can expand on, but is done obviously on a month-by-month basis based on the trade debtors.
Yeah, I mean, smaller arrangement fees typically, only really paying cost of capital while you're using the facility. I quite like invoice financing. It's not prohibitively expensive. My concern is if you've got a business that's got some element of seasonality to it, that inconsistency of flow of capital can make for unpredictable service of debt. I would always punt for something that's a bit more guaranteed in terms of fixed payments, and if you need to structure something on a term loan that maybe is more affordable in the short term, and you're riding the growth of the business, then a bulleted term loan that has a chunk at the end, a balloon at the end, if you like, that needs paying or refining, is probably the more manageable and consistent, and the type of facility that you can plan for on a regular basis. I don't like shadow boxing or chasing my tail, so IF is probably the useful for working capital post the acquisition, but maybe not so much for upfront consideration. But I know deals that use it and have used it successfully for the part of the consideration. But yeah. And then obviously you've got the other side of that coin with trade finance, right? So what if you're an importer? You're bringing in containers of something from PRC or Eastern Europe or something. Trade finance on the inbound can be quite useful because obviously you're cash flowing goods right the way through until you get paid, and your credit cycle could be 4 or 5 months from payment for goods until payment against your invoices that you've generated. So trade finance is often overlooked, but it can be an alchemical way of transforming businesses. If they run self-financing and now the cash is coming out of the business to pay some of the consideration, then trade finance is a useful tool. And there are facilities that exist which are, again, just pay for it while you need to use it, and often no arrangement fee for them, which can be quite nice.
Yeah, I think that goes for the same for both trade financing and invoice financing, in the sense that they're relatively lean, easy enough to set up, and give lenders enough security based on the fact that they're strong invoices that are essentially going to be paid back quickly based on the nature of the invoice payment term. So both of those, I think, are good options. And you're right, invoice financing tends to be more mainstream and spoken about, whereas trade financing feels less of a known, but it's a useful one based on your payment terms.
And of course, then you've got the security question. So you don't necessarily need a debenture on the business for some of the trade and invoice financing, whereas you definitely need it for a term loan. So it's about your appetite for putting up collateral or security. And as we mentioned earlier, like a lot of term loans are still, even under the growth guarantee scheme, are expecting some degree of director's personal guarantee, which can be a bit prohibitive. Just on the topic of servicing debt, like what do you feel is an optimal debt service cover ratio? You're going into a transaction. Many banks I speak to are sort of looking at 1.5x and above. If you read the works of Adam Coffey, he's never wanted to dip below 2x just for that comfort factor. You've been looking at deals that provide for 3x in the deal structure, which is fantastic for headroom. But what is optimal really in terms of using debt in a deal and manageable debt service cover ratio?
Yeah, no, I think it's a good question. I think naturally banks are already assessing that risk of the business and the acquisition and the debt profile, and providing their minimum requirement of that debt service coverage ratio. So they've kind of done the work for you on what they think is reasonable. And I think 1.5 plus, I think, is a reasonable target. However, I do think that the closer you are getting to that value, right, the more risk of taking on. I think dependent on the nature of that business and the growth plans alongside that and the serviceability alongside that, the higher risk, the more you should steer away from that and fall into Adam Coffey territory of 2+. And the more confident you are with the lower risk nature of a business, perhaps more recurring revenue, forecast free cash flows in a shorter period of time, the closer you can work towards, I think, 1.5. So I think it kind of depends, but for sure that should be a baseline. And I think lenders will reflect that in their requirements too, as you suggested.
Great advice. Nice one. Thanks, Adam. So the other side of the coin, which we probably should speak to with the time we've got remaining, from debt finance, is obviously bridging the equity gap. And as search funds do, selling some participation in the exercise, in the project. Traditional Stanford model being a 1.5x step up, which is probably the only asset class I know, or fund structuring I know, that gives that kind of a preference by default. Wonderful. Probably the reason behind the IRR being so high in certain funds versus venture and trad PE. But how how mature do you feel the investor market is for search funds in the UK and EU currently?
So I think still on the relatively immature side, but growing rapidly. As we spoke to earlier in the conversation, there's more and more of an appetite for investors to become involved in search funds, both more locally and, as we said, from overseas into UK search funds, as you alluded to earlier on in the conversation with a couple of search funds that have now been raised, which is great. So I think that the appetite is growing, and I think if there's a strong enough thesis there and credible searchers who can demonstrate their experience of what they're looking to acquire, I think that the appetite is there essentially. I think it's more around then, the people, and then how quickly you can then structure a deal with the right sort of company to drive it from search to acquisition, which is obviously the challenge. But we see search funds typically looking at an average of, I think it's just under 2 years in the US of how long it takes to go from search to acquisition. But hopefully, as that curve is on that trajectory, we'll see more and more funds being allocated into that space. And the more awareness there is, even more so, I think is going to drive investors to that.
Yeah, I mean, it still baffles me as to why in this day and age it should take 2 years to find and bring a deal over the line. I mean, that's the fundamental reason why searchers are giving up quite a lot of their equity. But yeah, so it has been as it has been, but that doesn't necessarily mean it will be that way in the future. And BizCrunch is hopefully a solution to improving the efficiency of all that. But the more and more search fund entrepreneurs that I speak to are still kind of naming a lot of overseas investors. I see a lot of family offices from Spain. I see some Northern and Western European funds specifically for searching, investing in search funds. We're pretty sparse here in terms of known high net worths and institutions that have a declared appetite for participating in search fund investing. What can be done?
So I think it's a combination of things, right? I think there's a piece around awareness for sure as an asset class. There's a piece around how we can share that knowledge to raise that awareness on the potential returns. I think there's another piece around helping improve search funds in general, like you said, by reducing the amount of time it takes to find companies to buy. And BizCrunch is obviously mission is to help, one of the missions within BizCrunch is to help do that. I think the more we can reduce the amount of time it takes to search and provide more transparent data as to the companies we're trying to buy, the more confidence investors are going to get into the type of deals and acquisitions that are being done at a faster pace. So I think there's a whole knowledge, awareness, transparency thing that can be done there. And at the same time, I think we still need to keep growing more and more searchers. I think searchers is key to this as well, right? The more people are taking the path of entrepreneurship through acquisition, which, in my early days, I went down the startup path and wasn't necessarily even aware of the entrepreneurship through acquisition thing. So I think it's not just an awareness and like an investor funding level, it's also an entrepreneur acquisition level as well, which can drive more and more into the space. What's your take on that?
No, I completely agree. Can't disagree with any of that. In fact, it probably comes down to increasing awareness of kind of a coming of age of the asset class, and it will gradually permeate the psyche or the subconscious of investors. I do think there's a job to be done on improving like ease of access to search funds. Like at the moment, there's lots of people that kind of in stealth that are reaching out asynchronously, independently. And to Pavel Prokofyev's point on LinkedIn the other day, that doesn't feel efficient. That feels like it's failing both sides of the coin. So yeah, I think there's something to be done on somehow providing a forum or a space in which ready investors that want to learn and participate in the asset class can connect with entrepreneurs that are seeking co-investment participation. So yeah, job to be done, but it does feel like it's reaching a bit of a moment of maturity now that hopefully gains some exponential awareness and activity, just like venture did sort of 20 years ago. So let's dive into that in more detail, maybe when we next meet on here and sort of see if we can solutionize, as I heard mentioned in a meeting the other day. So yeah, we've run our half an hour, and I really appreciate the chat. We'll get into some Q&A shortly, folks. So that will be an unrecorded part of this. So do throw your questions in your chat. Thanks to those that have done so already. A bit of parish news before we go. Do visit serialacquirer.uk. Grab your day pass to the symposium that is taking place on the 18th of June in central London. We've got some great speakers that are lined up for that, from former dragons through to financiers, investors, lawyers. It's quite a roster that we'll be publishing on the website soon, and some sponsors in the offing from some major banks, accountancy firms, and law firms. So yeah, it's gaining momentum. Be part of it. It is the place to be this year for the ecosystem of acquisition, entrepreneurship, and holdco building. So join us next week. We're going to try and make this a regular thing, Wednesday afternoons at 3:30 UK. Until then, thanks again for tuning in, and keep on crunching. Bye for now.
Thanks, everyone.